Hey everyone, welcome back to Nexus. I'm Nancy, and today we're diving into a question that's been on many people's minds lately. Why do we trust markets? It's a big question, and it's not as simple as you might think. The world of economics and markets can feel complicated, sometimes even impersonal. But at the heart of it all, there's a psychological side to our decision-making that helps explain why we trust these systems to guide our lives. From the prices we pay for goods to the investments we make, markets influence so much of what we do every day. So let's break it down and explore the psychology behind why we trust markets in the first place. First, let's talk about trust itself. Trust is a fundamental pillar of any functioning economic system. Without trust, markets would crumble. We all have faith that when we buy something, we'll get what we paid for, that when we invest, the value will increase, or that when we save, our money won't just vanish. But why do we feel this way? Why do we believe in these systems? Well, at its core, trust involves a willingness to be vulnerable, to believe that the actions of others will lead to positive outcomes. In markets, we trust that businesses will offer quality goods and services, that our investments will reflect the true value of companies, and that regulations will keep everything running smoothly. So where does this trust come from? The answer lies in our psychology. Let's start with cognitive biases. Now, these are mental shortcuts that help us make decisions, but sometimes they lead us to make irrational choices. And yes, these biases play a big role in why we trust markets, even when we shouldn't. One of the most powerful biases is something called the availability heuristic. This is when we make judgments based on information that's most readily available to us. For example, if we've heard success stories about people making huge profits in the stock market, we're more likely to trust the market's ability to generate wealth, even if we don't fully understand how it works. On the flip side, if we're constantly exposed to negative news during a market crash, we might feel anxious and doubt the market's reliability. The key here is that our memories are shaped by what's easiest for us to recall, which gives us a skewed perspective of how markets really work. It's easy to assume the market will always perform well when we've seen it thrive, and it's equally easy to believe it's doomed when we only remember the crashes. Another common bias is confirmation bias. This happens when we look for information that confirms our existing beliefs, ignoring anything that challenges them. So if you already believe that markets are efficient and lead to prosperity, you're more likely to focus on examples of thriving economies and ignore signs that things might not be as perfect as they seem. On the other hand, if you're skeptical of markets, you'll probably pay more attention to every failure, economic collapse, or corporate scandal, while dismissing the broader positive trends in market history. Our biases shape our trust in markets by reinforcing our existing beliefs, whether they're rational or not. Now, there's something else that influences why we trust markets, and that's the endowment effect. This is a bias where we tend to value things we already own more than things we don't own. So, if you've already invested in stocks or real estate, for instance, you're likely to feel more emotionally attached to those assets and trust the market more, even if signs of instability are starting to show. This attachment can make it harder to make objective decisions. You might hold on to underperforming investments for too long because you've already put your money where your mouth is, so to speak. The endowment effect helps explain why we trust markets. It's not just about logic, but about our emotional investment in the systems we participate in. But it's not just about cognitive biases. Social proof and cultural norms also play a huge role in why we trust markets. Social proof is when we look to the behavior of others to guide our own decisions. If everyone around us is investing, buying property, or spending money, we're more likely to trust that these are the right choices, even if we don't fully understand the underlying mechanics of the market. This is especially true when we see people we respect, like family members, friends, or influencers, thriving in the market. When we see the people around us doing well in certain economic practices, it reinforces our belief that markets work. And culturally, in many societies, the idea of owning property or investing in the stock market is seen as a pathway to success. So these cultural norms can make us trust markets even more. Let's also talk about institutions and authority figures. Institutions like banks, regulatory bodies, and governments play a crucial role in fostering trust in markets. When central banks set interest rates, or when governments pass new regulations, they help create stability. The role of these institutions is to regulate markets, ensuring fairness and transparency. And because we tend to trust authority figures and experts, we place our confidence in these institutions to keep markets running smoothly. Think about it. When the Federal Reserve raises or lowers interest rates, we trust that these decisions will have a positive effect on the economy, even if we don't fully understand the complexities behind those decisions. We rely on experts and institutions to navigate the chaos and reassure us that everything is under control. This trust in authority figures is one of the reasons we feel comfortable participating in the market. Now let's talk about the illusion of control and the way we perceive markets. There's a psychological need we all have to believe that we have some control over our futures. Markets, especially financial markets, can seem chaotic, but they often give us the illusion of rationality and order. We like to think that our decisions matter, that if we just make the right moves, we'll come out on top. There's this concept called the invisible hand, popularized by economist Adam Smith, which suggests that when individuals act in their own self-interest, it benefits society as a whole. This belief in market self-regulation is comforting because it suggests that markets will correct themselves over time, even if things seem unpredictable in the short term. This illusion of control keeps us trusting in the market because it feels like there's an order to the chaos, even if we can't always see it. But here's the thing. While trust in markets has contributed to economic growth, innovation, and prosperity, it also comes with risks. We've seen what happens when markets fail, like during the 2008 financial crisis or the dot-com bubble. These events remind us that, despite all the psychological factors that help us trust markets, markets aren't perfect. Trusting them blindly can lead to financial instability, economic crashes, and personal losses. So while the psychology behind why we trust markets is fascinating, it's also important to approach markets with a critical eye. Understanding the cognitive biases, emotional attachments, and social influences that shape our decisions can help us make more informed choices, whether we're investing, saving, or simply spending money. In the end, trust in markets is a complex mix of psychology, emotion, and reason. While markets can provide immense benefits, they can also be unpredictable and risky. By recognizing the psychological factors at play, we can better navigate the ups and downs of the market and make smarter, more informed decisions. So the next time you're faced with an economic decision, remember that trust in markets isn't just about logic. It's about how we think, feel, and interact with the world around us. That's it for today's deep dive into the psychology of market trust. If you found this video helpful, make sure to hit that like button, subscribe to the channel, and turn on notifications so you don't miss out on future content. Thanks for watching, and I'll see you next time on News Nexus.